Welcome to the Profitable Farmer podcast, where it's all about increasing the profitability of your farm by working smarter, not harder.
G'day and welcome once again to Profitable Farmer. The season continues to unfold for us, and I hope that spring is treating you kindly. In this podcast, and on the back of what has been a really compelling recent Farm Owner Academy event with our alumni members, I've invited FOA Founder Greg Johnsson to join me just to reflect on what our alumni members are achieving across their businesses, to talk about, I guess, the current dynamics of the industry that we're all in, and also to touch on some really important metrics and measures that help us understand resilience, liquidity, and the efficiency of our farm businesses. So really looking forward to this conversation. It's a really important one. I encourage you to grab a pen and paper and take some notes, and even just to self-assess on your financial literacy ability as we move through this conversation with Greg. Greg, in my opinion, is the number one financial business analyst, if you like, in Australian agriculture, and his ability to look at numbers and understand the performance of a farm business and then improve that business through the numbers is second to none. So again, I encourage you to grab a pen and paper and take notes and just self-assess, if you like, on how strong you are in this area. So Greg, welcome.
Thanks, Jeremy, and thanks everybody. Nice to be with you today.
Greg, we've just come off two really compelling days with our alumni members. These guys have been together and moved through our program over 3 years, but they've now been tracking in our alumni and continuing to improve their business and their financial performance over the sort of 3 or 4 years since then. How do you reflect on that event and some of the results that you're seeing them achieve?
Yeah, well, it was a great event, as you say, and it's always fantastic to spend time in the room with farmers, really looking at their businesses from a financial perspective, and just seeing how it really all, it all comes out once the year's done, and certainly, very very pleased and proud of the alumni group and what they're achieving. There's 23 people, I think 23 businesses in our alumni currently, and 6 or 7 of those businesses were significantly impacted by the fires of 2020, to the point of either losing significant amount of fences and pasture, which led to significant increases in hand feeding costs for the year, right up to losing all of their pasture, fences, livestock, or the majority of their livestock, sheds, houses. I mean, really, just incredibly devastating losses. And yet it's amazing how those businesses have bounced back in less than 18 months and been able to really, get their businesses back on track really quickly, because they understand the really key things that drive the profitability of farm business, and they're able to resurrect their businesses to a semblance of what it was prior to the fires. And obviously there's still a lot of work to do to get those businesses back to the pre-fire situation they were in, but pretty well all of those businesses that were affected significantly by those fires still turned in an operating profit for the year, which is a pretty phenomenal result, really. So really, it was a great a few days, and the results of the group as a whole were really quite outstanding. So I don't know if you want me to go through them, Jeremy, but I can certainly give you an overview, or the listeners an overview of what they actually achieved.
Yeah, would you mind? Would you just share some of the broader results, if you like? And just for everyone listening, these guys come together for 2 days once a year, and they're in the hot seat for 30 minutes or 40 minutes, where they share the results through benchmarks of their performance over their last 12 months and the trends in their businesses over 6 or 7 years. And then they have that group really challenging them on their numbers and helping them solve some key questions that they have that will help them unlock new potential and move forward. So, yeah, Greg, if you could just touch on some of the broader results and even a couple of the highlights for you, those people who are really shooting it out of the park.
Yeah, so across the whole group, the average assets under management was $11.3 million, and the average assets owned was about $7.9 million. And if you compare that to the majority of these farms, actually were in South Australia and just across the border in Victoria. So if we look at the Australian the ABARE results, the Australian Bureau of Agricultural Resource Economics results for South Australia for that same year, from the farm survey data that they do, the average assets owned in their survey was about $6.6 million. So these farms are slightly bigger than the average of the ABARE data, but not significantly bigger. The average equity for the alumni group was 87.4%, and the average ROAM, return on assets managed, which is a really good indication of the efficiency with which the assets being managed are being used to generate a profit. The average return on assets managed for the whole group was 4.7%. And when you compare that to the ABARE result, the Australian Bureau of Agricultural Resource Economics result for South Australia, the average was 2.6% for South Australian survey participants in that year. So very significant, very, very significant increase or difference above what the average of the ABARE data was. And as I say, 6 to 7 out of that 23 were significantly or heavily impacted by the fires. So really just a very amazing result and really outstanding. And I think that, that the sorts of range of differences that we had here is that, we had, I guess our highest return on assets managed was 8.9%, and that was a business that it runs in a 350 mil rainfall zone in upper southeast of South Australia, a wheat sheep property. So 8.9% is a fantastic result, and quite a number of people in the 7%, 6%. So really just quite phenomenal, and this is including, or not including, but this is taking account of the significant increases in land prices that all of these guys have experienced over the last few years, as you all have. So we factor in when we do our calculations for return on assets managed, everybody is asked to put in the current market value for the land that they manage, whether they own it or lease it or share farm it. We ask them to estimate the value of that land, the market value of that land, and that's used in the calculation of return on assets managed, which is the net profit being generated by the business divided by the value of the assets that are used to generate that profit. So phenomenal result, and really very, very pleased with what they've been able to achieve.
What really impressed me being part of that event is just the quality and the sophistication of the dialogue, Greg. These guys really know their numbers. They understand the trends in their businesses, and they ask really high quality questions of themselves and others, so that they're looking for the uplift and they're looking to uncover the next opportunity through their numbers. Would you agree with that, Greg? And how would you compare the quality of, I guess, the dialogue in that room compared to your assessment of the broader industry and that broader industry's financial acumen?
Yeah, well, it's very different. You're exactly right. They do have a high focus on what's going on with the business from a financial and production perspective, and what the KPIs, both the production and the financial KPIs for the business are telling them. There's no doubt that when you do that, and history of participants in longer term farm benchmarking shows us this, that when you do focus on the numbers and the KPIs around your farm business, that inevitably performance is around about 2 to 3 times that of the national average over the longer period. So it really is. It's just the fact of having that focus on the numbers, understanding what's going on financially with your business, and the production KPIs as well, that really help to drive better decision making. And so when we come together for these days and the people present their results for the year to the room, everybody gets a chance to have feedback on what's going on in their business and point out the things or ask the questions that they want to ask about what's going on with that business. And similarly, the owners of the business get a chance to really ask the room some really significant questions about future direction and how they can do this area or that area better or slightly differently. And, it all adds to a very dynamic opportunity to have insight into the business by a whole range of people who are skillful at what they do, and help to identify opportunities to further improve these businesses. And I mean, it really is, it's quite incredible when you think about the significant improvement in land prices or increases in land prices that have happened over the last few years, that they're still maintaining these sorts of levels of return on assets managed. And, yes, the prices are good. The prices for lamb and for wool, lamb's excellent. Cattle's great. Wool's okay. Grain prices are pretty good. But so that should lead to better results from a financial perspective for all farms across Australia. But the seasonal conditions in South Australia and Western Victoria last year, the 2020 growing season, were just about average. They wasn't fantastic. It wasn't a great year like some of the guys in New South Wales experienced. It was just an average sort of year. So this result, is just on the back of a fairly average seasonal conditions, good prices and excellent results from a financial and production perspective.
Thanks, Greg. Yeah, so for those of our alumni members that are listening, congratulations on those 2 days and on your results, especially through the adversity of fire that Greg mentioned for many of you. To our Platinum Mastermind members listening, you've got that to look forward to. The alumni group is a really special group and they are really going places, so something to look forward to. Greg, you touched on something I think really interesting there, and it's optimism in the industry. I feel like there's optimism across commodities in this industry now that perhaps there hasn't been for 15 plus years. What would your comment be on that optimism, how it compares in history, given your experience, and crystal balling perhaps on how you feel things might continue in that regard into the future?
Well, I think if you can't be optimistic about farming at the moment, then you're pretty hard to please. I've been involved in the farming industries directly for 40 years and indirectly for about 50 years. So, and I don't think, apart from probably the late 80s, I can't remember a time when it's been as good as it is currently. We've got this concurrence of a number of things that are just fantastic for farming. We've got excellent commodity prices pretty well across the board. We've got pretty favourable seasonal conditions now that and hopefully the drought situation that occurred in New South Wales and Queensland, is behind us for a little while, and we don't get back into that situation for a bit. So let's hope we've got a better run of seasonal conditions for a few years. We've got prospects for all of our commodities looking pretty good. We've got extremely low interest rates, which make the funding of debt within the business much more affordable. So, and it's I mean, even back in the late 80s when the wool market was booming and basically all you had to do was run sheep to make money, it was a very easy process. We still were struggling with with interest rates that were sort of in that 12, 13, 14%. So even, yes, the money was there, but the cost of debt was much higher as well. So I don't ever remember in my lifetime seeing this juxtaposition of the key factors around agriculture all being as favourable as what they are now. Obviously, potentially there's some headwinds. We've got, we've got to look at what's happening with our major trading partners, and there's rumblings about China and a whole heap of things that are all beyond our control. All we can really do is get out there and do what we do to the best of our ability, produce our commodities at the lowest cost that we can, and that will basically ensure that we remain profitable even if the markets do come off a bit. But really, if you can't be optimistic at the moment, then I think it's time to go and choose a different profession.
Yeah, it's wonderful to see. Greg, linked to that, we've seen, I'm going to say, unprecedented increase in land values. And I hear the question a lot lately around how can we possibly consider expansion, or what have we got to do so that we can justify taking on the block next door with land values doing what they're doing. What would your comment be about land value increase that we've seen? And what comment would you give to someone asking those questions around what they need to do, or how can they possibly justify an expansion step at this time?
Yeah, well, sort of, land prices have certainly, in the last few years, taken off after a fairly long period of being pretty static. I mean, I'm looking at a chart in front of me at the moment of the Australian trends in land prices, historic performances back to 1995. And for any of you who really want to look at this sort of stuff, there's these reports are available for free. There's a report called the Australian Farmland Values 2021, put out by the Rural Bank, and that's really, I'd encourage you to have a look at these reports, because it covers the whole of Australia, and also they have regional reports in there as well. And what it shows you is that land prices don't go up in a straight line. There's generally periods of or significant periods where land price appreciation is pretty flat, followed by short periods of fairly significant rises. And the last significant rise that we had in the country was in that sort of 2002 to 2007 area, when after the wool stockpile disappeared and wool started trading in a true market scenario again, and we had a lift in wool prices as demand and supply sort of became more into line again, and that was also coupled with some the beginning of the lift in land prices and cattle were okay at that point of time. So we had this bit of confidence in the industry at that point of time, after really a decade, the 90s, a decade of being very pessimistic. The outlook was very pessimistic. People were very flat. We had this increase in optimism, and then people started buying land. The demand for land went up. That also, to a degree, was probably exacerbated a little bit by the blue gum purchasing around the country. The blue gums at that point of time were buying a lot of country in southwest Western Australia and Victoria and South Australia, and that was driving the price for land well beyond its market value at that point of time as far for agricultural land. So that had no doubt had some influence on those prices, but there was a general increase in optimism at that point of time. And then from about 2007 right through till about 2015, things stayed pretty flat again. There wasn't much appreciation if you look at Australia as a whole. And then it started to take off in sort of 2015, 16, 17, and has continued, for right to the current time. And I think there's been some really interesting, influences here that have affected that, and probably not the least is the inflow of corporate money that's come into agriculture in the country, and particularly recently because of the COVID situation and really the depression in, I think, global financial opportunities, that corporate money always flows to where it can get the best return, and so it saw the opportunities in Australian agriculture as being significantly better than any other, or a lot of the other opportunities around the world. And so a lot of money started to flow into corporate money, started to flow into purchasing farmland in Australia, and where that stays or not will be very interesting to see, because as the world opens up again post COVID and gets back to the sorts of activities and levels of trade that it was prior to COVID, then maybe we'll see corporate money start to leave the country to some degree as well, and move to other areas where it might be able to make a better return. So I think that'll be interesting to see what happens there. But it doesn't matter. I mean, in the end, if you're a farm owner, if you're a land owner, I mean, your equity has gone up significantly in the last few years, and you should be really thankful of that, because it's it's the easiest way to generate wealth over time is through the owning and holding of land, whether it's rural land or residential property or commercial property or whatever it is. They all go up over time, and it's a great way to generate wealth without having to actually break your back doing it.
I've heard you say before that careful letting the past determine your future, or to that effect. I think there are a lot of people who have had to write out the last 10 or 15 or 20 years or even further experience those 18% and 20% interest rates. And often that renders us cautious to the extreme or risk averse or whatever. What would be your comment there, given that there is optimism and there is brightness of the future in and around a lot of commodities, and perhaps people's balance sheets have been strengthened by capital gain. What would be your comment to people in their decision making at this time, linking to some of those trends that you're seeing?
Yeah, I think that it's really important that you work with the numbers that are in front of you. What's happened in the past has happened, and it shapes your attitude, I suppose, shapes your view of the world to some degree. I mean, when my wife and I had our peak debt in farming, which was back in the mid '80s, our interest rates got to 23.5%. Now you don't pay 23.5% interest without there having some effect on your attitude towards your businesses, right? It burns, and it basically, that sort of thing's branded onto your brain for the rest of your life. But that, just because we had 23.5% interest rates back then doesn't mean that we're going to be looking at that scenario going forward. And similarly, when in the '90s, when we were shooting sheep, we were being paid to shoot sheep, and you couldn't sell sheep, that you're getting paid 50 cents for them. I mean, that's what's happened in the past, and I'm not saying it can't happen again, but you can't let those sorts of events, I guess, cloud your judgment about about the next 5 to 10 years. Nobody's crystal ball is better than anybody else's, but you can only work with the numbers that are in front of you. And so if you understand your business from a financial perspective, you have a very good handle on the KPIs, the financial KPIs, you're running a profitable business that's generating a good return on assets managed, then buying land at the current prices still represents a great opportunity. If you're making 5 or 6% return on assets managed with the current land prices, then what that means is that if you can take your current business and you can expand it out onto more land, then you can buy that land at that current land prices and you'll make 5 or 6% operating return, which is still a great investment, irrespective of whether you're making capital growth or capital gain or not. So even if the land prices, the appreciation flattens out for the next 5 or 6 years, then you're still making good return. It's still a good investment. Where it becomes more difficult is if your return on assets managed, the profitability of your business is actually low, then in that scenario, you're pretty well relying on your capital gain to generate your wealth. Your operating returns aren't generating much wealth for you. All they're doing, in a lot of cases, is just servicing the debt. So you're relying on that capital growth to generate your wealth over time. And if your time horizon is only 5 to 10 years, and we go into a period of flat land prices for 5 to 10 years, which is kind of what's happened. If you look back over the land prices, these flat periods for between 5 and 8 years, and then rapid rises, then you might find that piece of land isn't a great investment for you. But if your time horizon is longer, if you're looking to buy land and hold it basically for a long time into the future, then you'll capture those increases in land prices over time. The average, I think, for across the Australian landscape is around about 7% return on 7% capital growth on average per year over the last 40 to 50 years. So it's a significant wealth generator, but it doesn't all come in a straight line.
Makes for a great investment if you've got a long-term view, as you say. So, paraphrasing, know your numbers, step 1, optimize the farm that you have, step 2, and then go about expansion of that model, step 3. Even at these times, just reflecting back on the alumni group, Greg, I just see them being courageous. They're in control because they know their numbers. They've taken time to optimize the farm that they have, and now they're actively looking to expand. And, my favorite definition of courage is commitment plus doubt plus action. So there's always going to be the doubt, and there's always going to be the fear, and there's always going to be the worry and the what ifs. But I guess if you know your numbers, that gives you control. And from that point of control, you can be more courageous and take the opportunities that are presenting in the current market. Would that be a fair comment, Greg?
Yeah, that's absolutely right. I mean, there's no such thing as a risk-free decision in business. Every time you take a decision in business, it always involves a risk. But as much as possible, we want to deal with calculated risks, and so having a great handle on the numbers of your business and your KPIs allows you to make those really calculated risks. And so, if you have a business that has a strong return on assets managed, it has high finance cover, and is in a reasonably good equity position, and I'm talking about 80% or better equity, then there's no reason why that business shouldn't be able to look at expansion into more land and do a very, very good job of it. Because what I know from years of working with people that run extremely good farming businesses is that once the process is set, once they have everything running optimally on their property, it's not difficult to actually just expand that whole business onto a bigger area. The business is it's the ideal time to expand through land purchase is when your current business is optimized, because then you'll get the best return on that investment into the new land. So it really is a bit of a no-brainer. If part of your long-term vision is to get bigger through the acquisition of more land, then it's a bit of a no-brainer that when you've got your current business optimized and the right piece of land presents itself, that then you crack into it. But it can be the wrong decision if your current business is actually struggling, and you're already in a situation where your equity's not where it needs to be, where your profit's not what it needs to be, where your debt cover's too low. Then adding extra debt to the business can actually be a recipe for disaster. So it really comes back to really understanding what's going on in your business financially, and understanding those key KPIs around the finances of the business.
So let's touch on those, Greg. Those key KPIs, and I think the benchmarking that we offer is outstanding, and it just supports that resilience and that strength of all of our members. The three broad categories, I want to touch on those: resilience and the measures that help you determine and understand just the resilience of the businesses that we're operating. Then the efficiency metrics. Ultimately, we're commodity producers, so the key metrics that we need to analyse are our financial performance and our financial efficiency. And then liquidity and repayment capacity and some of those constructs. I sort of see it that we look through those three core constructs at our clients' businesses. Would you mind just speaking to those and perhaps some of the KPIs that sit under those three broad categories that people need to know so that they are in control of their numbers?
Yeah, I think it's really key, and you can look at by looking at about 12 key ratios, you can pretty well judge any farm business and have a really good understanding of what its current reality is, and it's just such an eye opener for people when they first go through a benchmarking process and they start actually generating these KPIs for their own business. That actually starts to open up a whole heap of questions for the majority of farm businesses that actually, and they're great questions too about how they can do a better job with their business and where they need to focus. And so the solvency resilience ratios, I mean, the key one there is equity percentage. It's such an important metric in farming business because farms rely on such a high amount of capital invested into the assets that they manage, but particularly farmland, that equity percentage is key, and it's the number one risk mitigation factor of farming. When the majority of farm businesses get into trouble either because of poor seasons or poor prices, where they go through years where profit's not where it needs to be, then generally the way out of that from the majority of businesses is to borrow against their equity. And so if you're in a situation where equity is poor, then that potentially leaves the business open to not being able to leverage that equity, to borrow against that equity to keep the business running. And it's and that's a very, very tenuous position for any farm business to get into, because if all of a sudden you can't get access to the funds to finish this year's program, whatever it is, then obviously the business comes to a grinding halt. And so equity is an absolutely important one. No doubt there'd be quite a few people in New South Wales after the several years of drought whose equity position took a significant belting. But equity is really the key one, and it's got to be based. Your equity's got to be based on the current market prices for the things that you actually managed, so the land and the livestock and the plant. You use market values. The equity calculations that are in your tax accounts aren't necessarily going to reflect the true situation. I really encourage people, anyone that's listening, to get a good independent land valuation at least every 3 years, particularly when land's going through these significant rises in value, because that's the only way that you can really understand what the value of your land is and what the value should be on the balance sheet. Plant is really the potential sale value of the plant that you've got that you in your portfolio. So what you could sell it for at a clearing sale, and livestock probably come up with a policy for valuing your livestock, but something like the average of the last 3 years prices for the various classes of livestock you've got access to. But that'll help you to set up the assets for the value of assets on the balance sheet, and then of course you've got your liabilities, which are a straight book value, and from there you can calculate your equity very easily, which is your assets minus your liabilities. So, and also remember that equity is not just farm equity. You can invest off farm and do a great job with putting together off farm wealth creation investments. And if those investments are reasonably liquid, or you can borrow against them, then there's equity there that you can tap into as well, to help support the farm business if things go a bit pear-shaped from a seasonal or price perspective. So, when you're looking at equity, think about not only the farm equity, but also the whole the equity of the whole of the owners. The owner's equity. What have they got that they can tap into should they need to do that? So that's the solvency and resilience one, and it's why bankers and people that you go to borrow money from are so keen to understand what your current position is, because your equity is a key component for them, followed by the debt serviceability. How much profit are you making, so that can you service the debt that you've got and the debt you might be wanting to take on, and what sort of security you've got to bring to the table to secure the debt you're trying to take on. So they're the three real keys for borrowing money. From the efficiency ratios, we've got profitability. I suppose understanding the profitability of the business is really key. How well are the assets of the business being used to generate profit, and return on assets managed is probably the best one there, and can be easily calculated once you've got your cash flow statement and you've got a profit and loss that you generate from that, and a balance sheet that you generate from that. It's very easy to calculate all of these KPIs, and return on assets managed can be calculated easily from those worksheets. But just as a rule of thumb, particularly in the current climate with such good commodity prices, 4% return on assets managed as a minimum should be a target that everybody should be aiming at. And 4 to 6% would be ideal. If you can't make good profit at the moment, then you definitely have got significant issues with your business that needs addressing, because commodity prices are so good.
When you say return in that, Greg, that's profit after a partner's salary or an owner's wage, and after all costs of the business. Is that correct?
Yeah, that's right. So return on assets managed is the net profit divided by the total assets being managed, and the net profit is the revenue that's generated by the property minus all of the costs, the direct and indirect costs, including an imputed owner wage. So we work on, irrespective of what you pay yourself, you should be working on what's an accepted commercial rate of remuneration for the labour that the owners of the business put in. So, and we're based on significant farm surveys that have been conducted over the last few years. We at Farmers Academy we work on $115,000 for the operating manager or the owner manager for a full-time year, so 11 months work. And we work on $70,000 for each family member that's contributing labour for a full-time year, 11 months work. So $115,000 for the principal owner and $70,000 for each owner's family labour unit. And that really is a reflection of what's being paid around the country, and is a commercial rate of remuneration for owner labour. And when you think about the average Australian wage at the moment of $89,000, nearly $90,000, then there's no reason why farmers and farm owners and anyone working in the farming sector shouldn't expect to be paid commensurate with what other people are being paid in other areas of around the country. And if as an industry we're not prepared to look at those sorts of levels of remuneration, then it's no wonder we lose people into the mining industries and so forth. Because why would they stay in agriculture and be paid not a lot of money for what is in most cases quite a physically taxing and mentally taxing job as well. So we need to get out of this mindset that that we can pay labour very little in farming. If you want good people, you have to pay them well. It's just a fact of life, and all of the businesses that we deal with that are very successful businesses with high profitability all have quality labour pools, and they pay them really well.
Linked to that profitability conversation, I really find that I get to understand a client's business at that next level when we get into their cost ratios. So, their wage ratio, their overhead cost ratio, their machinery ownership, and their machinery use ratios. Would you mind just speaking to some of the key cost ratios that do sort of link to efficiency?
Yeah, so financial efficiency KPIs really give you a great insight into how efficiently that the costs are being managed within the business. And I think the key metric here is the total operating cost ratio. So that ideally should be less than 70% for a farm business. So that's all of the costs. That's the direct cost, overhead cost, including imputed owner wages and depreciation for plant. That cost should be less than 70% of the revenue being generated. And we know that if you've got 70% or less operating costs for the vast majority of farmers across the country, that will result in a great level of profitability. Unless you farm, ridiculously high in an area where land prices are ridiculously high, then in most cases that 70% or lower total operating cost ratio will generate somewhere between 4 and 6% return on assets managed. So it's a key one to concentrate on. And then underneath that, the balance between overhead costs and direct costs tells you a lot about the scale of the business and whether there's enough scale under management. And when I talk about scale, I'm not here necessarily talking about the amount of land. I'm talking about the amount of revenue the business is generating. So there's a number of different ways of generating scale. One is to upgrade or intensify the activities on the current land area to generate more income, and obviously another way is to buy more land and generate more income that way. So increasing scale is an important, or having the adequate scale is an important part of running a successful farm, and these KPIs help you really identify that through the overhead cost ratio and then labour cost ratio. Labour cost ratio is one of the biggest. Labour cost is probably one of the biggest, if not the biggest, cost in most farm businesses across the country, and so having an efficient labour cost ratio is really important. And ideally, labour costs should be less than 15% of the revenue being generated in the business for an efficiently run business. And where it's not, it's very, very difficult to really generate sustained high profits when labour cost ratios are extremely high. So that's an important one. And then certainly for cropping businesses or machinery intensive businesses, machinery ownership ratio is really important. So that's the amount of money invested into plant and machinery divided by the revenue that plant and machinery generates. And ideally that should be less than 0.8. And what we've seen is over the years with the really good cropping businesses across the country is that they've been able to really manage that machinery ownership ratio to get it, under 0.8 sustainably. And it has a massive impact on the business and its profitability over the longer term. So far too many cropping businesses in the country have too much money invested into plant and machinery, or more money invested into plant machinery than they should have based on the revenue that they're generating. So once again, a simple ratio, easy to calculate, but gives you such a great insight into what the current situation is with the business, and then get you asking the right questions around what do we need to do to bring these sorts of ratios into shape, into the sort of levels that we need them to be. And as soon as you start directing your mind into these really critical parts of business thinking, that's when the real big breakthroughs occur.
Then there's liquidity, Greg.
Yes, repayment capacity, very important. So the ability to be able to service the debts and the recurrent land leases that you've taken on. And it's really important that businesses are able to service those debts, and they're serviced out of net profit. Your net profit's got a lot of work to do still. It's a profit you make, but after that, you've still got to pay. You still got to pay your interest and debt servicing costs. You've got to pay any land leases if you've got them. You've got to pay your tax. You've still got to have capital to reinvest back into the farm to maintain the farm capital assets. So, there's a lot of work to do with net profit. And if your repayment capacity is low, then basically the majority of your profit is being consumed at just servicing your debts and your land leases, and there's nothing left to reinvest back into the property to maintain capital assets and so forth. And so, what I've seen over years in farms that just don't make enough net profit and or have too high debt commitments or low finance cover is that the shortfall in the net profit to cover debt servicing and land leasing and so forth and capex requirements for the business, that shortfall comes out of the owner's remuneration. So the owners pay themselves nothing or very little because any money that they get it's not needed to pay the direct and overhead costs goes back to paying the servicing the debt, paying the land leases and investing back into the farm capital infrastructure to keep it up to scratch. So we end up with this situation where the farm owner and the farm family members, work long and hard and tirelessly for very little reward, which is really a poor situation to be in. So finance cover, it's the number of times that your net profit covers the debt servicing and land leasing costs of the business, and it should be at least 2. And healthy businesses are greater than 3, and preferably 4 times. And when you're in that situation where you have a business that has a solid return on assets managed, has a good equity percentage, has a good finance cover, then the business is ready to launch to the next level. If you want to do that, if the long-term goals of the owners are to increase the size of the land holding or the land under management, then that's when the business is in a great position to launch out and buy. If they don't want to do that, then borrow against the equity in the farm and invest off farm into wealth creating investments off farm.
Greg, it all amazes me when we come together for our 2-day top producers event, our introductory program, and we ask that question of 100 or 150 or 200 farm businesses, how many of you benchmark? It always amazes me that less than 10% put their hand up. How do you feel when we sort of see that as the reality in industry, and what's the risk of not knowing these numbers and not tracking them over time?
Yeah, I think it's a sad indictment on the industry as a whole, to be honest with you. It's even more shocking than that because, as you say, we've had thousands of people in our events now, and every time I ask them to put their hands up if they produce a cash flow forecast, a cash flow budget, and probably 50 to 60% of the room will put their hands up. And then the next question I ask is, do you leave your hand up if you update that cash flow forecast monthly with actuals, so that you can compare actuals with the forecast? And we're probably then down to about 10% of the room or less. Then the next question I ask is, okay, so how many of you then that do that then take that cash flow, that cash flow statement that you've produced after a year's worth of trading and create a profit and loss and balance sheet, so you can really understand the profitability of the business and your net worth position. And invariably, we end up with 1 or 2 hands up in the room. And I think it's a really sad indictment on the farming industry as a whole because, I don't think there's too many other. In fact, I know that there's virtually no other businesses in Australia where you can be in charge of so much money and really be flying blind. And by not producing those statements, you are flying blind. I don't know how anybody can make good, solid financial decisions and minimise the risk in those decisions without having those numbers to hand and having that visibility on their business in front of them. And, it's just a part of running any business. And I mean, I have been involved in a lot of businesses in my time and owning and running them myself. And I'm still involved in a number now. And I just couldn't even start to think about running a business without having that information in front of me. It's basically, it would be like driving a car with a blindfold on. And, if you do that in Australia, you're either going to get arrested or you're going to have a big crash at some point in time. And yet we can do that in business and nobody gives a stuff. And it really just amazes me, to be honest with you. So, so a lot of these situations that we see where people get themselves into financial trouble in farming, it's preventable. It's very foreseeable. And by just having an understanding or a visibility of the finances and the financial metrics, those situations can largely be avoided in the majority of cases. So because it happens slowly, car crashes happen very slowly in farming because capital gain, gets farmers out of a lot of difficult positions. But most people don't get into financial trouble overnight in farming. It's a gradual game, and you can see it coming for years generally.
No, it's a great point, Greg. Thank you. And so I want to give a program that we're running now a plug. Greg has, as you've heard, dedicated most of his extended career in industry refining the financial metrics that help underpin farming families succeed, and created the Farm Financial Framework program. And it is Greg's lifetime of work condensed into a short course that you can do online. It is for $1,500 at the moment, which is significantly lower price point than we would normally offer it. And we're offering it because we genuinely want to see farming families gain control of their financial literacy, get around these metrics and get the skills and tools so that you can understand your current reality and then move forward at this time with confidence. We run this campaign for Farm Financial Framework only once a year. It rounds out at the end of this week, and you can still get access to this program outside of this campaign, but not at that investment level. It's 5 really thorough and comprehensive models that give you financial control of your business, and it rounds out with a benchmark, perhaps your first, where you get these numbers applied to your performance on your farm, and perhaps gives you that first deep and meaningful assessment of your current reality. It's a very thorough program. It is very applied to our industry, and it's designed to give you what you need so that you can succeed in this industry and understand your financials so much more strongly. Greg, what would you say about Farm Financial Framework and perhaps the impact that you've had it or seen it achieve for so many people who've been through it?
Yeah, well, what I do know, Jeremy, is that all of the people that I've worked with over the years that run really high quality farming businesses, they all know their numbers. They all are very attuned to what's going on in their business from a financial perspective, and they know their financial KPIs. It's a key part of the whole process, and so our philosophy at Farm Owners Academy is actually to teach people to be independent. We're not trying to. We don't want to build dependence on the Farm Owners Academy consultants to generate these sorts of financial reports for you. The Farm Financial Framework is set up to teach you the fundamentals of financial control in any business. So this is particularly tailored to the farming business, but it can be used. The same principles can be used for any business. It teaches you how to all of the processes to actually to properly construct and use a cash flow forecast and generate a cash flow statement. It teaches you then how to create a profit and loss statement for your farm, and it teaches you how to create a balance sheet and then how to use those those various statements to generate the financial KPIs that we talked about, to get that real good visibility of your business, and then also to make great decisions, financial decisions to take you and your family in the direction that you really want it to go over your time as leader of your family business. And so it has that single focus in mind, that it's meant to teach you what to do and how to do it. And yes, we provide a financial report for your business at the back end of that training, but mostly as a reference against the calculations that you're doing yourself. I mean, all of the metrics that are generated for you in the financial report that we send to you, you learn how to generate yourself. And so, and once you've got that skill, then it's easy to take forward every year and start the process of really getting incredible financial control. And what I do know, after speaking to a lot of people that have been through the course, is that a lot of them say that they just have, they feel so much more in control of their business. Once they've got that understanding of the numbers and the finances of the business, they feel so much more in control of what's going on, and the decisions that they make are much more strategic and much more aligned to the current situation with the business and what's going on around them. So, I just think it's fundamental knowledge that everybody in farming should know. Unfortunately, it's not taught anywhere. It's not taught at school. It's not taught at uni. It's not taught anywhere. It really is fundamental knowledge. And the other thing I would say is it's easy. It's very simple. Once you understand the principles behind it, it's simple. And so we don't give you templates. If we gave you templates that would do the work for you, then you wouldn't understand it, right? So we teach you how to build those templates for your own situation. Because once you can build those templates and you understand what's going on, then you understand the whole process. And with that understanding comes incredible insight and control.
Thanks, Greg. So just a couple of comments from me to round this out. It is a cracking program, and it is unique in the industry, and it is making a real impact. We love that narrative, or that comment, that a ute or a motorbike or a tractor can be a university on wheels. So if we turn off the radio and put on a meaningful podcast or a course like this, that your time spent in the paddock can be very valuable, more so even than what it is that is your farm activity. And so this program does launch now, and it is coming into a busy time of year for us. I want to encourage you to think about it and use your time windrowing, harvesting, and whatever else as time where you can apply learning around this topic to your farm and to your own ability. It's perhaps really good timing to be making an investment in this course and using your time in the ute or on the tractor or in a truck to upskill over this harvest. Greg, thank you very much for your time. It's always great to connect, and it's great to be able to get under the bonnet and share some of the stuff that we work through with our Platinum Mastermind and alumni members with our broader community. So thank you for your openness and for taking us through those key metrics and your take on the current industry trends.
Thanks, Jeremy. And I'd just like to wish everybody all the best leading into the rest of the year, harvest and lamb selling time and all the rest of it, and leading into Christmas. And let's hope that 2022 is a much different looking year to what the last 2 years have been. It would be fantastic to all be able to start mixing socially again and get back to living the lives that we enjoyed prior to the start of last year. And I'm sure that's just not very far away. So all the best, and thanks for the opportunity, Jeremy.
Thanks, Greg. Good to have some time with you. And thanks, everyone. As Greg said, let's enjoy the optimism in the industry, and over the next few months, hopefully coming together and being back face-to-face with friends and family. Thanks for your time, Greg.
Thank you, everybody.
Bye for now.